Hello, everyone. We're going to give this another minute or two here, get a couple more people to join. Please be patient with us, and we will start here no more than one more minute. Thanks. All right. Hello, everyone. Good afternoon. I'm David Levy, one of the partners here at Diversified. I'd like to welcome you to our next installment of Wealth Webinar Series. Today, we'll be discussing the increasing need for long-term care, the different types of care, as well as different methods to protect yourself. In a moment, I'll welcome Michael Rowe, the brokerage director at IP Brokerage, who will be leading this discussion for us today. We here at Diversified have been working with Mike and his team for well over a decade now in helping us research and implement the appropriate life, disability, and long-term care solutions for our clients and friends. Per usual, we'll look to keep this about 30 minutes to get you back to your day. And to make things as efficient as possible, please type your questions in the questions section, and we will address them at the end if there is time. Of course, if your questions are not answered today, please reach out to us, and we will be happy to answer them for you. We are recording this webinar, and we'll be sending it out to you by email in a couple of days. We'll also have it posted to our website for easy access, and as always, please feel free to share it with anyone you'd like. All right, before we get this kicked off, I got a couple quick housekeeping items. Number one, please save the date for our next webinar on December 12th at noon, where we will be discussing year-end tax planning. Number two, please note our next Bring a Guest wine dinner will be the following evening on December 13th. Kelly will be sending out invitations soon, so please keep an eye out for them. As always, Kelly is always available to answer questions and take feedback on this or any of our events. All right, with that said, Mike, let's get this started.
Thanks, David. Good afternoon, everybody. Thanks to David and Kelly and the rest of the team at Diversified. I look forward to speaking to everybody today. Long-term care is something I strongly believe in, and I look forward to discussing it with everybody on the call. As David mentioned, I'm the brokerage director here at IP Brokerage in Philadelphia. We help financial advisors and planners across the country develop and implement risk management strategies for their personal and business clients. I'm here today to talk to you about the importance of long-term care planning and how you can protect yourself against the impact of an unexpected long-term care event. Here are some of the items we'll cover today during our discussion of long-term care. First, we'll take a look at what I call the second half of life and some of the issues that keep people up at night when they think about retirement. This will lead us into a discussion of long-term care, some ways to offset the risk of a long-term care event, and the current LTC insurance marketplace. There should be plenty of time for questions at the end, or feel free to ask any questions you may have as we move through the slides. So what is the second half? It's your opportunity to try new things and not have to worry about the 9-to-5 grind. The second half is your chance to focus on what you want to do, whether that's a lot or a little. It's up to you to decide. What we see here in this slide is that life expectancy overall is becoming much longer in this country. Did you know that in 1900, the average lifespan was 47? Today, it's closer to 80. That's a lot more time to spend enjoying retirement, but for a lot of people, that's also time they're not earning income. As we saw in the previous slide, the good news is that you're more likely to live a long life today than you were 50 years ago. With the medical field making huge advances on diseases and conditions that years ago might have been fatal, lifespans are increasing. Because of that, preparing for a long life is a necessity. While living a long life is something to hope for, it is not always synonymous with living better. First, a longer lifespan may require more money to maintain a desired lifestyle. And second, the longer we live, the more likely we are to need someone to help take care of us. This can create a financial hardship and can derail some of those things that have been planned for the second half. We need to consider who will care for us and where we want to receive that care. So what keeps people up at night as they think about retirement? What do they think will keep them from winning in the second half? Here are results from the 2016 Insurance Barometer study from LIMRA. When asked about their financial concerns as they pertain to retirement, the top things people focus on are medical expenses, including long-term care, and outliving savings. People want to be able to handle the rising cost of healthcare and protect themselves from a long-term care event. And they want to have enough money to do everything comfortably.
Mike, who was polled for this?
So one of the interesting things I think about this study is they didn't just look at pre-retirees. They really they looked at everybody from millennials up through people already in their retirement ages. So it's a really broad range of ages. And I think it's interesting to see that even, sorry, go ahead.
So it's all ages.
It's all ages. And what I think is interesting is that even the younger groups are already concerned about having enough money for a comfortable retirement, but also paying for those unexpected costs that arise due to medical issues at that time.
Yeah, it's interesting.
So what is long-term care? Long-term care covers a wide range of supported services provided to those who are not able to care for themselves due to a chronic illness, disability, or severe cognitive impairment. This care is expected to be needed for a period of at least 90 days. So it's not the short-term recovery from an operation that some people may, have to endure after in a hospital stay. It is expected to last for a longer period of time, at least 90 days. Long-term care can also be described as help with some of the activities associated with day-to-day living, better known as the activities of daily living, or ADLs. As you can see on this slide, there are 6 ADLs. They are eating, bathing, dressing, toileting, transferring, and continence. Those are all pretty self-explanatory. Transferring is the ability to get up out of bed and move to a chair, or move
Mike,
to another, move throughout the house.
And how many of these generally do you need help with to qualify?
To qualify for an insurance claim, it's 2 of 6.
Okay.
So if you cannot eat or dress yourself, then you can potentially qualify for a claim. The other trigger for long-term care insurance is severe cognitive impairment.
Okay.
And these long-term care services,
No, go ahead.
Okay, they can be received at home, in the community, or in a nursing home or assisted living facility.
Okay. And who generally, I guess it's a question we get a lot is, who is the one that determines that one needs help? Is it self-explanatory? Is it their doctor? What's the process there?
In most cases, it's the individual's primary care physician.
Okay.
It is, yeah.
Cool. Thank you.
Sure. Unfortunately, long-term care is also a reality. I'm sure that some, if not all, of the people on today's call have a family member who has needed care at some point. Statistics show that 70% of people over age 65 will need long-term care services and support at some point in their lives. And how long do most people need this support? The average length of the majority of long-term care claims is almost 4 years, and the average life expectancy after an Alzheimer's diagnosis is 4 to 8 years.
Mike, how many of those are Alzheimer's? How many claims are specifically to Alzheimer's? Do you know?
Most of the claims experience that I've seen from the insurance companies in the market today, it's around 34 to 36%. So it's a substantial amount of the claims are related to Alzheimer's or dementia.
Okay.
And if we look on the next slide here, there are some additional numbers regarding Alzheimer's. So currently there are 5.7 million Americans living with Alzheimer's. That number is projected to rise to 14 million by the year 2050. It is now the sixth leading cause of death in this country. To put this growth in perspective, between the years 2000 and 2015, deaths from heart disease have decreased by 11%, while deaths from Alzheimer's have increased by 123%. So it's a huge increase just over the past 15 years. At present, more than 16 million Americans provide unpaid care to this growing population. These caregivers have provided an estimated 18.4 billion hours of care valued at over $232 billion. So it's an understatement to say that Alzheimer's has become a big deal. And as we'll discuss a little later, these numbers have had a significant impact on the LTC market.
Mike, do you have any idea how many of that 16.1 million are still working?
Of the 16.1 million, 6.6 million are currently working. That's about 5% of the workforce. And some of the statistics from the Caregivers Alliance show that these people who are providing unpaid care typically miss about 7 hours of work per week. That's almost 18% of a 40-hour work week. So, the impact on the caregiver is substantial. It's the person who needs the care is probably having a financial hardship of their own. And then if you take an adult child of that person and require them to miss time from work, it also impacts them. So, that there's significant impact for caregivers.
Sure.
So hopefully we know at this point what long-term care is. We know that as we age, it becomes more of a reality. And as many of you have probably experienced firsthand, long-term care is also becoming more expensive. Here are the annual median costs of care for the three main types of care: home, assisted living, and nursing home, according to Genworth's 2017 Cost of Care Survey. In-home care, the median cost across the country is $49,000. Assisted living comes in at about $45,000. And then nursing home, as I think everyone would expect, is significantly higher at $97,000 per year. And that's the average between a semi-private and a private room.
Right. And to break that down, that's about $8,100 a month for the nursing home.
Correct.
That's a lot.
It is. It's substantial. And if we add, if we look at what it might cost in 20 years, if we allow for 3% growth, in-home care is closer to $90,000 now. Assisted living is $81,000, and nursing home is all the way up to $176,000. So, there's significant growth there. It's already expensive, and there's no end really in sight to how much it is going to grow.
And do you have, Mike, any statistics handy on the percentage of, do more people need to go to a nursing home? Is it done at home? Is there any progression? Anything you can elaborate on those?
Sure. Most people want to receive care at home. It's obviously going to be much more familiar to them. It's more comfortable, and that's where most of the claims do occur. Genworth does a nice job publishing their claims data every year, and they show that 54%, of LTC claims are home-based. 14% are in the assisted living facilities, and 32% are in nursing homes. But if you talk about progression, 69% of claims do start in home, and then ultimately, as the person becomes more ill, they're either forced to move into the assisted living facility or a nursing home.
Right. So,
so more than half.
Two-thirds of the claims start at home, where over half of them ultimately stay there.
Correct.
Interesting.
So these are the numbers, the median cost of care across the country. I assume most of the people on the call today live in the Northeast. So on the next slide, we can take a look to see how the national median compares to the Delaware median. So here are the numbers we saw on the previous slide for in-home assisted living and nursing home care. And if we throw the Delaware numbers up there, in-home care is about the same. Assisted living and nursing home care are both substantially more. And those numbers play out pretty much the same way in Pennsylvania, New Jersey, Maryland, and the rest of the Mid-Atlantic.
Okay.
So it's clear that long-term care is a reality and it's expensive. In our experience, we see three common misconceptions when it comes to paying for long-term care services. The first revolves around public programs like Medicare and Medicaid, both of which have limitations. Medicare generally covers skilled nursing home care after a hospital stay of at least 3 days, and its coverage for other long-term care services is very limited. Care must also be received in an approved facility. Medicaid does contribute towards long-term care, but requires recipients to use their income to pay for care and spend down most of their assets to qualify. The second misconception regards the use of personal savings to pay for long-term care services. According to a Lincoln Financial study, advisors estimate that an unplanned long-term care event may cause clients to draw down their assets 2 to 3 times faster than expected. This becomes especially problematic if the surviving spouse is left with less than ideal assets or income. The last is the expectation that a family member, whether it be a spouse or adult child, will provide care if needed. We've already seen that 16.1 million Americans provide unpaid care to people with Alzheimer's or other forms of dementia. Here's another statistic. According to the National Center on Caregiving, a woman taking care of her disabled spouse is nearly 6 times as likely to suffer from depression or anxiety as the general population. So I touched earlier on some of the impacts on caregivers, and I think that's significant right there. So the woman who takes care of a disabled spouse, 6 times as likely. So what are some alternatives to these 3 options here? It shouldn't really be a surprise that I'm going to talk about some insurance options. After all, long-term care insurance is what I talk about more on a day-to-day basis with my clients than any other insurance product. There are 3 main types of products we use to protect against the risk of a long-term care event. The first is traditional long-term care insurance, a product that has been around in varying forms since the early 1980s. So when this product was first designed, it was designed to pay for long-term care. It's classified as a health insurance product. It typically offers the most robust level of care because it is designed for one thing and one thing only. It offers inflation protection. In the past, we sold 5% compound inflation. That's usually down to 3% now, just due to some pricing changes. One of the issues that we do see with traditional long-term care, because it's regulated as a health insurance product, it is subject to rate increases. And at least current products have a lifetime premium structure. In the past, you used to be able to pay for 10 or 20 years and then have a paid-up policy. That's no longer possible. So the other 2 options are more recent and increasingly popular entrants to the market. The first is a life insurance plan, usually a whole life or universal life product that has a long-term care or chronic illness rider. With this type of product, if the insured qualifies, and that's 2 of 6 ADLs or severe cognitive impairment, a portion of the death benefit can be accelerated on a monthly basis to pay for care. This product typically works best if life insurance is the primary goal and not long-term care. But nonetheless, it does work. In this situation, if a client was to buy, say, a $100,000 life insurance policy with a 4% LTC rider, they'd be able to access about $4,000 a month to pay for covered long-term care expenses. Some products are reimbursement, meaning you have to hand in the receipts from the nursing home or your home health care aide, and then you get reimbursed. Some of them are indemnity-based, where just every month you get that maximum monthly benefit, and you can actually pay for what you see fit. It doesn't have to be for covered expenses. It could be to take a vacation if you really wanted. So there's a little bit more flexibility there. And then hybrid or linked benefit products are the third option. These products are similar to the second, but they typically offer more robust long-term care protection and less death benefit. There's also a return of premium feature that can be utilized if the plan is no longer needed. A couple of things that stand out for the hybrid products that I wanted to point out here is whereas the first 2 are usually designed with a lifetime pay structure, the hybrid products are either a single pay or a short pay, maybe up to 10 years or age 65. And they're also designed to be issued on a simplified issue basis. So the first 2 are fully underwritten. There are phone interviews, there are applications, there are medical records. But with the simplified issue products, there's typically just a phone interview and then an accept or decline at the end of that.
Mike, and you sort of just hit on it, but we got a question here as far as
Sure.
applying for a traditional long-term care versus applying for a life insurance with an LTC rider. The underwriting is one more lenient than the other, and I think you might have just answered that. But is there anything else to add?
No, I don't think one is more lenient than the other. With traditional long-term care, they're focused on morbidity. It's how sick do we expect this person to become over time. When you're looking at a combination product where there's life insurance and LTC, there's the mortality aspect of it that comes in a little bit, more significantly. So, someone with a heart attack 8 months ago, we can sometimes get them traditional long-term care insurance at a standard rate. But if they were to apply for, say, life insurance with that rider, it's a different story because the risk of premature death is just so much greater if there's that existing heart disease there.
Sure, and since all of the underwriting and application process is based on age and health, right? I mean, we generally don't bring these up until around 50. What do you see as far as the common? When do people start to consider insurance?
So, 10 years ago, if you asked that question, I would say most long-term care buyers are about 60. That number started to creep down. The product is becoming more expensive. So the younger and healthier you are when you buy it, the less expensive it's going to be. So we start seeing people now closer to 50 looking at the traditional long-term care insurance. Life insurance with an LTC rider, that could be any age. We see you can buy, whole life on your grandchild and throw the long-term care rider on there so that, 60 years down the road when they need that coverage, it could already be there. So that's not uncommon anymore.
Okay.
The hybrid products are usually about age 45 and up.
Okay, thanks.
Sure. So today I've tried to present somewhat of a neat and tidy overview of long-term care and some of the ways to help offset the risk of a long-term care event. But it's not always that simple. The LTC market, we've kind of just touched upon some of these things. As many of you have no doubt experienced or seen in the news, has experienced some upheaval over the past several years. First, insurers have seen the need to reprice existing blocks of business. This has been a difficult experience for consumers, especially for those on fixed incomes. There are a number of reasons for these increases, but insurers typically cite higher claims experience, low mortality, and lower than expected lapse ratios as the primary factors. We've also seen many companies, including some very well-known names like Metlife and Prudential, exit the market altogether. And finally, some of the statistics we covered earlier have led to underwriting and product changes. Pricing overall is higher than it was in the past, and that's why we're starting to see younger applicants. Companies have introduced gender-distinct pricing since claims experience shows that female insureds have received more than 70% of claim dollars. So 10 years ago, a 54-year-old male would pay the same as a 50-year-old female. That is no longer the case, and that 54-year-old female will now pay significantly more for a traditional long-term care product. Family history of Alzheimer's is now a factor in underwriting, and that precludes people from getting, the best rate classes. Unlimited benefit periods are no longer available with traditional long-term care. And, these are just some of the changes we've seen. There have been quite a few. I do believe we'll see more changes in the future, but it doesn't really take away from the fact that LTC should be a part of the retirement planning process. It's just too big a piece of the overall puzzle to ignore, in my opinion.
And Mike, you mentioned that Metlife and Prudential have exit the marketplace. For
Sure.
anyone that's listening or will listen to this later, while they exit the marketplace, they will still honor the policies they've issued. Is that not correct?
That is correct. They continue to service the in-force block of business. They're just no longer issuing new contracts.
Okay. And so if they've left and the industry's been around since the 80s, how many companies are still in the marketplace versus how many give or take, were there, 20 years ago?
In 1990, there were about 100 different insurance companies writing long-term care insurance. Today, we're down to about 12. There are some other companies out there doing it, but 12 who have a significant presence in the market. And those are companies that are writing about 2,500 policies or more a year.
Okay.
So there's a significant decrease in the number of options.
Okay. We got a couple questions here.
Sure.
Coming in here at the end. In regards to the raising rates, somebody's asking about, they've seen that they've gone through a couple rate increases and they've been given opportunities to keep the premiums the same. Is that a common occurrence when premiums are on the rise?
It is, absolutely. There's a long process for an insurance company to raise rates on an in-force block of business. And it's important to keep in mind it's that entire block of business. So it could be all policies that were written between 2001 and 2004. They can't single out individual people. And we've always seen these companies offer landing spots for the clients. So maybe take a year off of the overall benefit period, reduce the monthly benefit, change the inflation option.
Sure.
So there are landing spots for people, and we run through those on a weekly basis, trying to help people figure out what the best option is.
Right. We do have a question here that's somewhat specific to them, I think, but I'll change it a little bit to make it more general here. But the questioning is, how do they know that the policy that they have now is sufficient? And so, right, I mean, it's insurance at the end of the day, right? So you could insure what's probable, and you said, 30, if I go back to my notes here, you said 32% of claims make it to nursing care, to an actual nursing
Correct.
home, versus the 54 that stay at in-home, and the price difference there is $4,200 to $8,100. So I don't know if you have any comments there on, what is a good policy to have, and I know everyone's situation's different. So
yeah, everyone is going to be a little bit different. I always think it's better to insure at least some of the risk than all of the risk. If people were to go out today and buy a policy that would cover 100% of the cost of a private bed in a nursing home facility, it would be expensive. And the risk that you run, at least with the traditional long-term care policy, is that you may never need it. You don't want to overpay and then never need it. So there's a happy medium in there, and we can go through some of the statistics on like what an average long-term care policy looks like. Right. Most people today start out at $150 or $200 a day. And if we know that the average stay in a facility is 3.9 years, we at least go with the 4-year benefit period. Things like shared care, where spouses share the benefit pool, are also a really good idea.
Right. Okay.
So it's tough, and it's your own, what you're comfortable spending for the policy also plays a factor.
Right. And it's clear that there's becoming more of a need to protect, and thank you for going through some of the backstory, some of the statistics, in the whole long-term care world, and some options to consider to sort of de-risk that for you. So thank you for joining us today. We don't have any more questions, so we'll end a few minutes early. Everyone can go grab an earlier lunch than they were expecting, so you're welcome for a couple of minutes back here. But thank you everyone for joining. Thank you, Mike, for your time.
My pleasure. Thank you for the opportunity here.
Yep, and your partnership over the years. So with that, everyone have a great rest of their day, and hopefully we'll see you online here in a couple months for our next webinar on the 12th. Thank you, and have a good day.